So what's your take on this bang-in-line CPI print? You could see under the hood there's disinflation coming from energy and there's some inflationary pressures coming from housing and elsewhere.
Well, first of all, when you look at an employment report or a CPI report, the truth is CPI is almost always what the analysts think, because we have a lot of data going into it, which just makes it very hard to have a big surprise. So not surprised that we're not surprised. Having said that, I think there is a clear disinflationary trend. There are a lot of cross currents, a lot of cross waves in the data this morning. You know, things like airline fares up, but tobacco prices, not moving as much as they did last month. Differences in medical commodities and services. But beneath it all, I think there are a few things to bear in mind. One, we're going to have lower tariff costs going forward than we've had a year ago, because the new tariffs are not going to fully replace the IEEPA tariffs. Second, I do think that eventually oil prices will come down, because eventually there's only one solution to this thing, and everybody's always got to get out of the Strait of Hormuz, and I think it will. But the biggest thing to me is this is the fourth consecutive month in which wages have gone up by less than CPI inflation. 3.2% year over year in wages, 3.4% on CPI. And what that tells me is American workers can't get a raise. And if they can't, you cannot have sticky inflation. We've essentially got Teflon inflation in America. It won't stick, and it won't stick because you've got this, you can't get a price-wage spiral going if the wages won't react.
We haven't seen inflation coming from the labor market for a while, though. Yeah. This has been coming from one supply-side shock after another, and there have been many consecutive ones. At a certain point, when does it stay sticky? Like, how do you define sticky? It's been more than 5 years, and so it really hasn't been led by that.
Well, it's been more than 5 years on a year-over-year basis, but it takes about a year to fix a year-over-year problem. That's the first thing. So if you actually look at it on a 3-month basis, there have been plenty of periods where inflation has fallen below 2% over that 5-year period. It's just on a year-over-year basis. As you say, we've had one supply shock after another, but they've been, COVID and the policy response. We had Ukraine. We've now had the Iran war. We've had tariffs. Most of this is actually, most of it, apart from the Ukraine war, is policy decisions. I mean, the inflation we have right now are policy decisions on immigration, on tariffs, on the Iran war. If we back off, and I would even think that with more divided government next year, quite possibly, we will back off on these things. I think inflation will gradually come down. I think the wise thing for policymakers to do here is just let it happen. It's going to work slowly. That's just how it's going to be.
When you say policymakers, you mean Fed officials. You think that the Fed should stay on hold?
Absolutely, they should stay on hold. I actually think they will. I mean, I noticed just after this report, we just saw a further slight decline in expectations for a Fed rate hike. And every confirmation that we're on a downward path. I know it's not coming down as fast as anybody would like, but you can do no good by trying to hurry this process. There's it's like an injury. It just heals slowly. And if you try and speed it up, you're just going to mess everything up. So we have an inflation problem, which we're going to heal slowly here.
Right. And if the data is coming in either bang in line or a little bit softer like it did last month when it comes to inflation, then why do you see more Fed officials becoming more hawkish?
Well, I think they want to sound hawkish, but ultimately, I think they have a real communications problem. I think that they are on entirely the wrong track by saying we're going to communicate less. And so I think right now there are various.
Well, it's only one. That's the Fed chair.
Well, yeah, but I think it's important that the Fed chair try to reflect the consensus on the committee and tell markets about it. So I think the Jackson Hole speech that Kevin Warsh is going to do at the end of this month, that's very important, because I think at that point he's going to have to back off a little bit from his very aggressive rhetoric and say, admit that and acknowledge that there's some progress in inflation. It's not as fast as we'd like, but there's some progress, and there is a cost to everybody in raising rates if you don't need to do this, and if it's healing on its own.
Do you think that if the Fed did raise rates, that would actually take control of the long end of the yield curve a bit more, that will create a better financing environment, because it could suppress some of the concerns about Fed credibility and longer-term inflation taking hold in the system?
I think it's a close call, because the other thing is that if they do that, then what's to say they won't also then start attacking the balance sheet? And the one thing that's going to push up the long end of the yield curve is if you try and pull down that balance sheet. So I think that would be a kind of mixed message. Ultimately, I think the most important thing in deciding inflation expectations is how long does it take us to get to a settlement in the Middle East, some sort of settlement that allows traffic resumed there.
Does it really matter whether the Fed hikes rates by 25 or 50 basis points? Because pretty much everyone who we've talked to say that the fiscal stimulus that's coming from all the AI companies that keep doing all this CapEx spending is insensitive to where the Fed funds rate is.
It doesn't matter for the economy. It does matter for markets, because there's a lot of leverage in the system. There's a lot of leverage bets in financial markets right now. You increase the cost of leverage, that could help the markets, hit a peak and come down. So I think it could. And I'm not saying I think the markets are too frothy, but again, there are other things we probably should be doing to try to rein that in rather than just raising interest rates.
So you think that it really is a financial market response to the rate hikes that could potentially be problematic because of how much leverage there is in the system?
Absolutely, yeah. And if you do hike and you've got higher short-term rates, then the temptation is to move to a little bit more safety, and that could take some of the wind out of the market sails. So that's where I think you'll see the response. So interest rates matter for financial markets. Honestly, they don't matter that much for the economy anymore.